Okay, boys and girls, we have coming up on 3 minutes now until we get Jay Powell, the man with the printer, JP himself. So let me just get the Fed audio to come in here. Sorry, there's been a little bit of a bump around between the streams, but I've got the right one now going live. So still getting used to this streaming live on YouTube thing. It's simple when you get there finally. All right. So I'm gonna bring in this lovely Fed music here. It's in the background. Actually, no, that is horrible music. I'm gonna keep that well away from my ears. So I think a lot of people are looking for a retest on the 86.80s in oil. I don't know if that's going to happen. I think we can easily get 88.84s and certainly 88.13s, which has been my target on this move within this session. We do have 3 minutes, well actually 2 minutes for the pit close on oil. Let's see if it's currently some buyers lifting it here. Let's see if they can push this on up. It's unlikely. That'd be quite the move for a close. What would that be? That would be that'd be almost a 1% move. Not gonna happen on this closing session. I think they're gonna slam it down to 86, 88s. Big range on the Nasdaq. I had to open the window here because I was literally going to boil to death. Here we go. Let me just get the audio. So he's now reading out that
support of these goals, the Federal Open Market Committee kept its policy interest rate near zero and stated its expectation that an increase in this rate would soon be appropriate. The committee also agreed to continue reducing its net asset purchases on the schedule we announced in December, bringing them to an end in early March. As I will explain, against a backdrop of elevated inflation and a strong labor market, our policy has been adapting to the evolving economic environment, and it will continue to do so. Economic activity expanded at a robust pace last year, reflecting progress on vaccinations and the reopening of the economy. Fiscal and monetary policy support and the healthy financial positions of households and businesses. Indeed, the economy has shown great strength and resilience in the face of the ongoing pandemic. The recent sharp rise in COVID cases associated with the Omicron variant will surely weigh on economic growth this quarter. High-frequency indicators point to reduced spending in COVID-sensitive sectors, such as travel and restaurants. And activity more broadly may also be affected as many workers are unable to report for work because of illness, quarantines, or caregiving needs. Fortunately, health experts are finding that the Omicron variant has not been as virulent as previous strains of the virus, and they expect that cases will drop off rapidly. If the wave passes quickly, the economic effects should as well, and we would see a return to strong growth. That said, the implications for the economy remain uncertain, and we have not lost sight of the fact that for many afflicted individuals and families, and for the healthcare workers on the front lines, the virus continues to cause great hardship. The labor market has made remarkable progress, and by many measures is very strong. Job gains have been solid in recent months, averaging 365,000 per month over the past 3 months. Over the past year, payroll employment has risen by 6.4 million jobs. The unemployment rate has declined sharply, falling 2 percentage points over the past 6 months to reach 3.9% in December. The improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand remains historically strong. With constraints on labor supply, employers are having difficulties filling job openings, and wages are rising at their fastest pace in many years. While labor force participation has edged up, it remains subdued, in part reflecting the aging of the population and retirements. In addition, some who would otherwise be seeking work report that they are out of the labor force because of factors related to the pandemic, including caregiving needs and ongoing concerns about the virus. The current wave of the virus may well prolong these effects. Over time, there are good reasons to expect some further improvements in participation and employment. Inflation remains well above our longer-run goal of 2%. Supply and demand imbalances related to the pandemic and the reopening of the economy have continued to contribute to elevated levels of inflation. In particular, bottlenecks and supply constraints are limiting how quickly production can respond to higher demand in the near term. These problems have been larger and longer lasting than anticipated, exacerbated by waves of the virus. While the drivers of higher inflation have been predominantly connected to the dislocations caused by the pandemic, price increases have now spread to a broader range of goods and services. While the drivers of wages have also risen briskly, and we are attentive to the risks that persistent real wage growth in excess of productivity could put upward pressure on inflation. Like most forecasters, we continue to expect inflation to decline over the course of the year. We understand that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
All right, just check here now. Dow coming testing on this 200 EMA here on the center right of your screen. It's just a bit of pressure here. Okay, so it's held quite well all day. You can see above the 200 EMA pretty much since 8 a.m. So just be mindful of this. I still think it's supported. I really do think it's still supported. Dollar though, we're looking at a breakout on the upside for the dollar. I am holding short from just below pivot on the euro. Now expecting a range expansion to the downside and new lows on the day. So expecting this a really good move to the downside on the euro here. Now longs for the brave on the Nasdaq. This is not financial advice. This is just contextual awareness. All right, back to Jerome. On Jason, yeah, on the beers. No, this is a pretty tame event, to be honest.
Sustained high levels of monetary policy support. That is why we are phasing out our asset purchases and why we expect it will soon be appropriate to raise the target range for the federal funds rate. Of course, the economic outlook remains highly uncertain. Making appropriate monetary policy in this environment requires humility.
There's the dollar. See, there's the dollar now rising up new highs
in unexpected ways. will
We're
need to be
Jerome
nimble
here for a second
so that we can
on
respond to the
visual.
full range of
All right,
plausible
targeting
outcomes.
96.41s on the
With this in
Dixie,
mind,
so looking for a
we
break
will
on the
remain
weekly
attentive to
low
risks,
here on the
including
euro.
the risk that high
We can
inflation is
really
more
run
persistent
down
than
here on the
expected,
euro. Look at this.
and are prepared to respond as appropriate
Don't
to
go.
achieve
I would
our
not
goals.
recommend shorting this at all.
To provide
here. It's
greater
gone. The
clarity
trade is
about
gone.
our approach for reducing
All
the
right,
size of the
so
Federal
let it go.
Reserve's balance sheet, today the committee issued a set of principles that will provide a foundation for our future decisions. These high-level principles clarify that the federal funds rate is our primary means of adjusting monetary policy, and that reducing our balance sheet will occur after the process of raising interest rates has begun. Reductions will occur over time in a predictable manner, primarily through adjustments to reinvestments so that securities roll off our balance sheet. Over time, we intend to hold securities in the amounts needed for our ample reserves operating framework, and in the longer run, we envision holding primarily Treasury securities. Our decisions to reduce our balance sheet will be guided by our maximum employment and price stability goals. In that regard, we will be prepared to adjust any of the details of our approach to balance sheet management in light of economic and financial developments. The committee has not made decisions regarding the specific timing, pace, or other details of shrinking the balance sheet, and we will discuss these matters in upcoming meetings and provide additional information at the appropriate time. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Federal Reserve will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Okay, important there on the Q&A.
Thanks, Michelle, and thank you, Chair Powell. So it's expected that the Fed will hike rates perhaps every other meeting, but certainly in the past, the Fed has hiked at every meeting. So I just wanted to ask, are rate hikes at consecutive meetings on the table this year? Is every meeting a live meeting? And on that note, would the Fed consider front-loading some of its rate hikes, even if it doesn't raise every meeting? Thank you.
Thanks. So as I referred
reaction
to in
on
my
the
opening
Dow down
statement,
here. The reaction on
it
the
is
Dow
not
off of that
possible to
level
predict
there.
with
Really nice
much
activity.
confidence exactly
Similar
what
stuff on
path
the
for our
Nasdaq.
policy
We've
rate
seen
is
a
going
lot
to
of this
prove
today so
appropriate.
far.
And so at this time, we haven't made any decisions about the path of policy. And I stress again that we'll be humble and nimble. We're going to have to navigate cross currents and actually two-sided risks now. And I'll say also that we're going to be guided by the data. In fact, what I'll say is that we're going to be led by the incoming data and the evolving outlook. We'll try to communicate as clearly as possible, moving steadily and transparently. So, more to your question. We know that the economy is in a very different place than it was when we began raising rates in 2015.
I think Jerome
Specifically, the economy is now much stronger. The labor market is far stronger. Inflation is running well above our 2% target, much higher than it was at that time. And these differences are likely to have important implications for the appropriate pace of policy adjustments. Beyond that, we haven't made any decisions.
Thank you. Let's go to Victoria Guida at Politico.
Hi, Chair Powell. I wanted to ask, you were talking about the health of the labor market, and I'm curious whether you would characterize where we're at right now as maximum employment, and also along those same lines, obviously rate hikes on the table this year. Do you think that the Fed can raise rates, bring inflation under control without hurting jobs and wages?
Sorry, just getting both parts of your question written down. So I would say, and this view is widely held on the committee, that both sides of the mandate are calling for us to move steadily away from the very highly accommodative policies we put in place during the challenging economic conditions that the economy faced earlier in the pandemic. And I would say that most FOMC participants agree that labor market conditions are consistent with maximum employment in the sense of the highest level of employment that is consistent with price stability. And that is my personal view. And again, very broad support on the committee for the judgment that it will soon be appropriate to raise the target range for the federal funds rate. The other thing is maximum employment will evolve over time and through the course of the business cycle. In the particular situation we're in now, it may well increase. The level of maximum of employment that's consistent with stable prices may increase, and we hope that it will as more people come back into the labor market, as participation gradually rises. And the policy path that we're broadly contemplating would be supportive of that outcome as well. So the thing about the labor market right now is that there are many millions of more job openings than there are unemployed people. So you ask whether we can raise rates and move to less accommodative and even tight financial conditions without hurting the labor market. I think there's quite a bit of room to raise interest rates without threatening the labor market. This is, by so many measures, a historically tight labor market. Record levels of job openings, of quits. Wages are moving up at the highest pace they have in decades. If you look at surveys of workers, they find jobs plentiful. Look at surveys of companies, they find workers scarce. And all of those readings are at levels really that we haven't seen in a long time, and in some cases ever. So this is a very, very strong labor market. And my strong sense is that we can move rates up without having to severely undermine it. I also would point out that there are other forces at work this year which should also help bring down inflation. We hope, including improvement on the supply side, which will ultimately come. The timing and pace of that are uncertain. And also, fiscal policy is going to be less supportive of growth this year, not of the level of economic activity, but the fiscal impulse to growth will be significantly lower. So there are multiple forces which should be working over the course of the year for inflation to come down. We do realize that the timing and pace of that.
Let's just have a little check-in. All right, you got the Dow now back to the 200 EMA. It's a little bit of annihilation going on here on this level. Not necessarily super weak here. Nice little bit of repricing. Nasdaq testing the 14,370s. Euro really the best trade for me, so I'm still shorting in this area up around here and pivot. And I think we can stretch a little bit further down with this dollar with more to go.
What does that mean? And then apart from moving sooner and faster to shrink the holdings, are there any other ways in which you and your colleagues are seriously thinking about recalibrating this process? And finally, how much disagreement is there around how you should use this tool, including active sales rather than passive sales or changes in the composition of reinvestments? Thank you.
So I'm afraid to tell you that those are all great questions, and they're questions that the committee is just turning to now. So we had a discussion, as you know, at the last meeting, an introductory discussion of the balance sheet and a teeing up of the issues. At this meeting, we've gone through and carefully put together a set of principles at a high level, and those are meant to guide the actual decisions we'll make about the pace and about all of the questions that you're asking. And I expect that this process will be something that we spend time on in coming meetings. I can't tell you how many, I can't tell you how long it will take, and then, at the appropriate time, we'll provide additional information. So the last cycle when we went through balance sheet issues, we did find that over the course of 2 or 3 meetings, for example, we did come to interesting and better answers, we thought. So we're just in that process now, and at the next meeting, we'll be turning to, more of the details that you're asking about. I would say this: the balance sheet is much bigger.
You're seeing
it has a shorter duration than the last time.
And the euro really
much stronger, and
inflation
inflation
is
is much
that
higher.
dollar pressure.
So, and I think that leads you to, and I've said this, being willing to move sooner than we did in the last time, and also perhaps faster. But beyond that, it's really not appropriate for me to speculate exactly what that would be. But I would point you to principle number 1, which is the committee views changes in the target rate for the federal funds rate as its primary means of adjusting the stance of monetary policy. So we do want the federal funds rate, we want to operationalize that, and we want the balance sheet to be declining in a predictable manner, and we want it to be declining primarily by adjusting reinvestments.
So if I could follow on that, raising rates and reducing the balance sheet both restrain the economy, both tighten monetary policy. How should we think about the relationship between the two? For example, how much passive runoff is equal to every quarter percentage point increase in your benchmark rate?
So again, we think of the balance sheet as moving in a predictable manner, sort of in the background, and that the active tool meeting to meeting is not both of them, it's the federal funds rate. There are rules of thumbs, I'm reluctant to land on one of them that equate this, and there's also an element of uncertainty around the balance sheet. I think we have a much better sense, frankly, of how rating.
All right, just to give you a little bit of a color here, in case you missed it. So essentially, they're not ruling out raising interest rates at every FOMC meeting for the rest of this year. All right, now, do we automatically think that that's going to be 11 interest rate hikes or 10, from March through to the end of the year? Not really, but the market is definitely digesting that to the downside right now. So that's uber hawkish, and I don't think Jerome has really picked up on the fact of how hawkish that can come across initially. So you're seeing these markets now coming back on that. I don't really think that it's that warranted, really, but I like on the Dow, look at this line in the sand area. I think we're going to reclaim that, and we're going to be back up above 200 EMA quite quickly. Would I be would I be buying into this dip right now? Well, that's this isn't an investment advice, right? So the euro got a lot of ways to go now with Dixie up on R2. I think in this line in the sand, we may continue to rise if he doesn't start to sound a bit dovish against that prior statement. Labour market is consistent with maximum employment, which is also his personal view. Right, we'll go back to Jerome here.
And I don't want to comment on today's financial conditions broadly, but we're not looking at any one market or so. So that's how we're thinking. In terms of what we've seen, I would say this. We said at our last meeting, we published a summary of economic projections, the median participant expected 3 rate increases this year. And, it's 6 weeks, 7 weeks later now. And you have seen that our communication channel with the markets is working. Markets are now pricing in a number of rate increases. Surveys show that market participants are expecting a balance sheet runoff to begin, at the appropriate time, sometime later this year, perhaps. We haven't made that decision yet. So we feel like the communications we have with market participants and with the general public are working, and that financial conditions are reflecting in advance the decisions that we make. And monetary policy works significantly through expectations, so that in and of itself is appropriate.
Thank you. Let's go to Howard Schneider.
For a year hi, thanks, Chair Powell. Howard Schneider with Reuters. So for a year now, the statements reference the benchmarks for this initial interest rate increase. Now that we're approaching that moment, what are the benchmarks going to be for subsequent rate increases? I know you can't stipulate the path, but how should we think about the criteria for the next
All right,
step?
just a note here, right? So you're getting the Dow, for example, slip below that line in the sand. We've been acting as support here really on this most of the day. This meeting is not enough to push us lower on equities beyond, I think, the lows on this week. I think we're now going to find support here on this line in the sand and get our head back up above water. I just think that statement was a little bit out of pocket, really, on raising rates once every month from now on. Come on, Jerome. I don't buy that. I don't buy that. So I think the Dow is a little bit cheap here, to be honest. Well, actually, a lot cheap.
Should show through fairly quickly after that.
If I could follow, just on a related question, the December steps had this copacetic sort of set of circumstances where inflation comes down without the federal funds rate ever getting over the estimate of neutral. Given developments since then, do you still think that's a credible narrative for the ultimate path of policy?
The path is highly uncertain, and that we're committed to using our tools to make sure that inflation, high inflation that we're seeing, does not become entrenched. So a number of factors would be, it's not just monetary policy. A number of factors are supporting a decline in inflation, as I mentioned. Fiscal policy will providing significantly less of an impulse to growth. We do expect this year, although we do expect now that it will come slower than we had expected and hoped, that there will be relief on the supply side. So that too should lower these supply side barriers, which are a big part of the story why inflation is high. In addition, monetary policy will be becoming significantly less accommodative. So the question is, we'll be asking this question all year long, and that will be, are things turning out as we expect? There's a case that for whatever reason the economy slows more and inflation slows more than expected. We'll react to that. If instead we see inflation at a higher level or a more persistent level, then we'll react to that. And again, we're well aware that this is a different economy than existed during the last tightening cycle, and our policy is going to reflect those differences.
Thank you.
Thank you. Let's go to Gina Smialek.
We'll cover one more question here, and then
Let's go to Gina.
we're going to wrap it up. So Gina, give us all you got, Gina. Right, Gina
Okay,
has just
let's go
done
to
her
Steve
ass in the NASDAQ. Probably she can't take the call.
Thank you, Mr. Clinton. Thank you, Mr. Chairman. Mr. Chairman, I have one sort of technical question and one question on principle. The technical question is, if you're going to discuss balance sheet at the next upcoming meetings, and you won't begin balance sheet reduction until after you begin rate hikes, it seems to technically mean that you won't or can't begin balance sheet reduction until the summer. Is that correct? That's the first thing. Second of all, you suggested that the with balance sheet running in the background, that you would possibly be raising rates and running off the balance sheet at the same time. That's sort of a
Elite Team
question.
ARPB long up on
The
Dow.
question I have is, you said it's going to be running in the background, but the statement on balance sheet principle says the committee is prepared to adjust any of the details of its approach based on economic and financial developments, which suggests there's something of a reaction function associated to the balance sheet, and it won't be running in the background. So could you give us any a sense of the discussion or staff presentation on what is the reaction function surrounding the balance sheet? Thanks.
So let me start by talking about that last paragraph. So you'll remember during the last cycle that this process of building up and then shrinking the balance sheet is a complicated one, and it involves inevitably surprises. And so during the prior cycle, we amended our balance sheet principles a number of times. Now, we didn't intend to do that. Events required us to do so. So we got a pretty robust paragraph there that says we're free to do this at any time. And it doesn't mean we're going to, but if the situation turns out to be different than we had thought, we're not going to stick with something that isn't working. That's all that's saying. It's meant to be quite a general statement rather than a hint. So, I mean, I like to think that our philosophy of the balance sheet is embodied in these principles. So, the idea that, for example, the federal funds rate is the primary means of adjusting the stance of policy, that will determine the timing and pace of reducing the size of the balance sheet to foster the dual mandate, that will begin to reduce the size after we begin the process of raising rates, and on like that. I mean, those are all the things that try to describe how we will proceed. But it may be at a higher level to try to get at your question. Asset purchases were enormously important at the beginning of the recovery in terms of restoring market function, as they were right after in the critical phase of the global financial crisis. And then after, they were a macroeconomic tool to support demand. And now the economy no longer needs this highly accommodative policy that we put in place. So it's time to stop asset purchases first, and then at the appropriate time, start to shrink the balance sheet. Now, the balance sheet is substantially larger than it needs to be. We've identified the end state as in amounts needed to implement monetary policy efficiently, effectively in the ample reserves regime. So there's a substantial amount of shrinkage in the balance sheet to be done.
All right, I'm cutting them off there. It's now very, very dull. So I'm just going to keep the audio in my ear in the background. But now the selling on pressure on the Dow is really abated. Nasdaq R1 holding up, and SPOOs. Really, the buyers are trying to defend 43.69s here, but it's shark food at the moment. Really, this line in the sand on the Dow is what I believe in and what I'm looking at here. Dollar now pushing up back into these highs, scaled out something on euro on these lows, and leaving runners on for the ultimate destination is 121.25's top left of your screen here. So a nice handy little trade to be had there from quite early on in the session. That ARPB on Dow seeming to play out now after a little bit of flushing for the lead team there. Certainly the wind not on its back right now, let me tell you, but it's shaping up quite nicely. All right, so that's what we've gotten out of the FOMC for January meeting 2022. Just to kind of have a recap here, what we've gotten is, let me see from the statement. Not much really. Just the only hawkish thing we really got here was the ending of the repurchasing or the purchasing program by early March. The language is a little unclear here, but and I quote, "will bring bond buying to an end in early March, unchanged. Releases principles for reducing size of balance sheet, unanimous decision." So you can take that as early March is done. So that's unchanged from the prior statement. A couple of questions coming in about some boring stuff in the background here. I'm just going to leave that off. Then from the Q&A, really the worst thing that we've heard here is that the FOMC pretty much is trying to reserve the right to raise rates now at every meeting, which essentially leaves 11 more meetings for the rest of the year. Are we going to have 11 rate hikes? I mean, 0.25, because they would only raise at a minimum of a quarter, by 11, that's going to be 2.75% interest rate at the end of the year. Well, sure, as a 2.75% Fed's fund rate sounds great from where we are right now from their point of view, but that would be an incredibly aggressive and hawkish stance. So just get my camera back on for Discord. I think he's just kind of airing that out there to say that be ready at any meeting, and so with that, volatility is going to be really high for 2022. If we're coming into every Fed meeting with the possibility of a rate hike, you're going to see pretty wild moves the same way we've seen this week. You're going to see moves like that every week leading up to a Fed meeting. I may be wrong, but I don't think so. All right, we've come through the 8 o'clock marker, and the Dow is still holding on the downside. The Nasdaq coming further down to test again on the R1. SPOOs testing the lows since this meeting. T-Note seems to be tuckered out on the downside move. All right, that's where I'm going to leave you. To everyone in YouTube, you have a little sample here of what we do every day, Monday through Friday on these markets. Um, I think it's really important to be able to look at these markets and get these trades. Got to identify the right areas to trade, really, and then just wait. So listen, thanks for tuning in. Please do click to subscribe and like on YouTube, and to the Discord Pro Trader guys. I will see you in the morning, 8 a.m. All right, have a good one. Talk to you tomorrow. Cheers.